Hi everyone! Last week all three benchmark stock indices scored solid gains. January is likely to be a favorable month for stocks as they have been recovering since its start. Now traders are expecting a less hawkish stance by the Fed amid a slowing inflation, worsening economic indicators and mixed earnings reports. Market sentiment in February will mainly depend on the Fed's meeting results. This week, investors will finally find out about the Fed's rate decision. The majority is betting on a 25 basis point rate hike. Apart from that, traders are sure to take notice of any hints about further plans for monetary policy. This is why the comments of Fed policymakers could have a bigger impact on sentiment rather than the rate hike itself. If the regulator decides to adjust its stance, it will be a crucial moment for the equity market. The earnings season is in the spotlight. This week, Apple, Alphabet, Amazon, Meta and Pfizer will publish their revenue results. So far, quarterly reports have been rather weak. Hence, speculators have low expectations. Watch our video review and learn more interesting details. Leave your comment down below. Let's start. Last week, traders analyzed a batch of fresh U.S. economic reports. The figures turned out to be mixed. However, they clearly indicate that there is a high chance of a soft landing, which is a strong driver for stocks. GDP for the fourth quarter was noticeably higher than expected. In addition, few analysts had expected an upward revision of the GDP figures for the third quarter. It means that the recession scenario for the current year looks unlikely. Weekly labor market data was also encouraging, so the prospects for consumer spending look bright. Investors are mostly pessimistic. Yet there are those who believe in positive shifts. Therefore, there was no steady rally on Wall Street. Some still expect the economy to slide into a recession due to sharp rate hikes by the Fed. Judging by the comments of Fed policymakers, the regulator will hardly take a pause in monetary tightening. The February meeting will show whether this assumption is correct. Perhaps investors, as it often happens, are overly optimistic, counting on a positive outcome for the U.S. economy in the near future. One should also pay attention to weak December data such as retail sales and industrial production reports. This may be a sign that the economy is losing momentum. Analysts predict a contraction in the next 2 quarters. It's rather curious to see the market reaction to it. Will investors interpret it as a recession or temporary decline? Time will show. Last week, investors were looking for clues about the Fed's meeting results. The regulator switched to a blackout period until February 1st. Thus, the sentiment on stock market was set mainly by earnings reports. Revenue results have been rather disappointing. It gives food for thought. Even with modest expectations, the companies missed forecasts, so 26% of firms undershoot revenue estimates, while 25% of companies showed weak net profit results. Microsoft also revealed a contradictory report showing the slowest growth in 6 years. The company cautioned that a broader slump could continue as both consumers and businesses put their brakes on spending. The initial reaction to the report was positive. Microsoft shares rose by 5%. Later, they dropped as investors were scared by the grim prospects of the IT sector as a whole. Intel and Silvergate Capital shares declined by 6.4% and 3.7% respectively. American Express stock soared by 10.5%. Visa shares climbed by almost 3%. Tesla stock demonstrated explosive growth. It surged by 11%. This is a whopping daily gain for an electric car manufacturer. Its shares advanced amid the publication of financial results for the past year. Besides, the figures look rather impressive given the fact that in early January Elon Musk broke the world record for the largest loss of personal fortune in history, according to Guinness World Records. Over the past 6 months, Tesla shares have plunged 3 times. They declined nearly 4 times from their highs. Market participants are puzzled about what to expect from Tesla in the future. Will the company be able to regain the trust of investors? Save for Musk's escapades, Tesla as an automobile business is on track. For the NASDAQ 100 last week turned out to be quite profitable. It logged the largest increase among the key indices, climbing by 4%. Investors are now tracking the price movement near 12,000 as it an important uptrend line. Currently, there are no reasons for optimism, so the bulls are cautious, which is not a good sign. They are unwilling to take control of this level. In addition, they also missed 11,500. As a reminder, in 2018 and 20, long-term buyers entered the market at this level. The new week kicked off less positively with the consolidation of indices in the red zone. NASDAQ declined the most. Its intraday losses exceeded 1%. Investors are wary ahead of the earnings reports of large tech companies and the Fed's rate decision. Everyone was so certain about a slowdown in monetary tightening and the soft landing of the economy. However, the situation is rather ambiguous. The Fed could prepare a hawkish surprise. It is also too early to declare victory on inflation. Some economists fear it could remain high for a long time. What's happening with prices now makes traders reconsider their views. Oil and other commodities rose sharply. The energy market may escape the consolidation phase and return to the highs. As a result, a new inflationary driver will appear. The economy has been struggling with inflationary pressure for a long time, so new drivers are extremely unfavorable. Perhaps the Fed will have to take extra measures to cap inflation. If so, the stock market is likely to slide into a bear market again. The S&P 500 showed a steady rise. It managed to consolidate above the 4,000 level. There was also an attempt to break through the 4,100 level. It seems that a turning point has come. Its further trajectory will depend on the following factors. If the price goes down again, the bearish trend will prevail. If the index approaches 4,100, the index is likely to start a sideways trend. A close above 4,101 could initiate this scenario. Bulls will be able to count on further upward movement to 4,150 and then 4,300. However, the main question now is how long the current rally will last. There are almost no drivers. Market sentiment is turning sour due to weak earnings reports. The target levels for the S&P are located at 3,700 and 4,000. Compared to the last 2 years, the earnings season is unfolding without surprises when it comes to sales and profit results. The figures have stopped exceeding forecasts, which means analysts need to slash forecasts for 2023. The Dow Jones advanced by 1.8% last week. The volatility of all 3 indices could increase in the coming days as the Fed may remain committed to a hawkish stance. However, almost all investors believe that the Fed is unlikely to raise the rate by more than 25 basis points. The regulator is projected to undertake 2 more hikes, bringing the rate to 4.75 and to 5% by June. Then monetary easing is likely to start. However, the Fed may once again repeat that the rate will be raised above 5%. This week, the economic calendar is quite eventful. There will be a batch of fresh macro stats and economic reports. Yet, the main highlight is the Fed meeting, so traders could ignore some of the reports. Uncertainty about the Fed's further steps is mounting. There could be a surge in volatility. Everything will depend on the rhetoric of the central bank. Last week, the Bank of Canada caught off guard investors with its statements. It announced the end of the tightening cycle. Some analysts assume that the Fed could follow suit. If so, the risk appetite will increase. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you!